The uncertainty in financial markets in early 2018 served as a good reminder to investors that the low volatility environment experienced throughout 2017 may not persist. But where should investors focus their attention as we approach the middle of the year? And how could geopolitical tensions affect markets over the second half of 2018?
The first half of 2018 was all about midterm elections in the United States and about Italy in Europe, both actually creating a lot of headlines, lots of uncertainties. When it came to the US, we saw activism from the US government. They were all over the place with regard to Iran, in North Korea, in trade wars, in intellectual properties versus China, and so forth. So a lot of uncertainty created there. When it comes to Italy, of course, we saw some heavy turmoil there around the formation of a new government. Also some clashes which we will see continuously about the way forward in Europe. So this was all affecting financial markets, and we expect that to remain in place for the third quarter. For the US, because we're definitely turning into the hot phase of the election campaign, so more of the same. And also for Italy after the summer break, September, October, I expect some turmoil and debates about what's going to happen with regard to the European Union. So this will create uncertainty, further volatility, price fluctuation in financial markets. We do not think that they will be derailed by that, simply for the fact that this is not likely affecting the underlying economic picture, which is very strong at this juncture, and we expect that to continue. And therefore, we rather see those turmoils as buying opportunities in the third quarter.
Investors should be aware that markets might still be affected by political events in the third quarter of 2018. In general, we do not expect any of these issues to reach a level that would endanger the Western economy's energy supply or interrupt global supply chains.
Over the past few years, markets were driven by liquidity and low interest rates. This is going to change because we've seen that the Fed already started to shrink their balance sheet and also started to raise their interest rates. But it comes in a good time. Profit margin, profit outlook is bright, and looking also from an economical perspective, the growth in global economy is positive and profit margin is widening. Within equities, we look for sectors which are able to grow their revenues faster on a stable base. Financials, we see there, especially in the US, a earnings power from the US houses, and also we see for European banks, they have a low valuation. We have technology. Technology, we like the fact that they're able to exploit in growth markets, social media, but also streaming services. With cyclical consumers, we get an exposure to the strengths of the business cycle. And that is a great element where the stocks, the cyclical consumer stocks, will take over the baton from the bond proxies. Within emerging markets, we like the Asians, which have a great exposure to the IT sector. We recommend to stay invested in equities. But this year, we may be faced with a bumpier road than a one-way street. Stay focused in terms of a selective approach and for the right sectors.
Fundamental trends are still intact. We are aware that the current bull market is rather mature, but we forecast that 2018 will be a positive year overall for equities. In contrast, fixed income investors face a challenging environment across the whole credit spectrum in developed markets.
We stay defensive on the fixed income markets. Investors must be aware that we are in the middle of a big regime change. The Fed is no longer predictable. It has achieved its target of full employment and 2% inflation. So every meeting will be live. Good numbers mean interest rates and bond yields will move higher and vice versa. And this volatility is not priced in yet. In this environment, we stay positive for money market instruments to remain flexible, Treasury inflation-protected securities, which capture the upside of price pressure. We stay negative on high yields because we believe the rising refinancing costs are going to be a big problem for a lot of companies. In emerging markets, we stay neutral We think that emerging market corporates are much better positioned to finance these rising costs than a lot of US companies. Things look different in Europe. The European Central Bank is not to raise rates anytime soon. That said, they have distorted that many segments on the fixed income markets, there is no value left for investors. And we recommend unconstrained fixed income strategies to capture whatever there is left. And basically we still like equities more than fixed income in Europe and Switzerland, where rates are very, very negative.
The world is in the late stage of the economic cycle. The environment for fixed income investors remains challenging. The same applies to commodities, as these face significant upside and downside risks as a result of political noise and high levels of uncertainty. We continue to favour equities over fixed income. The good news is that currently we cannot find any excessive valuation levels. Now is not the time to sell.